Hey, this is Nick from Income Digs with a video tutorial on QuickBooks Online for real estate investors. We're going to talk about why profit on your real estate deal is not equal to the cash that you get at closing. Okay, very common question I get is we have an investor that goes through a project, maybe they did well and they get their cash, they get their check at the end of the project, and then they look at their profit and loss in QuickBooks and they wonder why the two aren't the same, right? And I kind of get what's going on here. We have a mental thought that, hey, the cash I get at closing should be my profit, but it's not the case. The accounting we do on the QuickBooks side is different than the cash we get at closing. And there's a few different factors that are going to impact and influence whether our cash at closing is close to our profit and why it is different. Okay, there's many reasons for that. So I just want to take some time to go through some examples today and understand exactly why that is. All right. Now, everything that I'm teaching in this little mini lesson here is something that comes out of my course, Real Estate Accounting Bootcamp 3.0. I encourage you to check that out, whether you're a bookkeeper or a real estate investor. Everything you need to know about investing in real estate and when it comes to QuickBooks Online is in that course. But let's get to what we're talking about with this video, which is why our cash at closing is not necessarily the same as our profit. Okay, so there's three main reasons. And again, we're going to go through these on QuickBooks and I'll show you what I mean. So first is whether we're purchasing with cash or with financing. That's going to be a big impact on whether our cash at closing equals our profit and why it might be different. The amount we actually spend on the renovation, okay, if we're renovating our properties, and the construction escrow holdback. So I'm going to go through all of these examples and you're going to see why almost never the profit on a project is the same as cash at closing. So let's get into QuickBooks and I'll show you what I mean. To demonstrate this, I'm going to go way back in time. We're going to go back in time to a balance sheet in 2018 that is completely empty. The first thing I want to do, I just want to throw some cash in my account here. So I'm just going to do a bank deposit and I'm going to put some owner's investment, owner's equity into this. Okay, so this has nothing to do, I just kind of I don't want negative values here. So I'm just going to put a deposit into an account and I'm going to say that it came from me there. And let's just put in 250,000. Okay, we'll leave class blank. Okay, so all I have so far, $250,000 in the bank. So let's purchase a property. Okay, now to start with, let's just purchase the property with cash. And I'm going to do this really simple. Okay, I'm going to pretend we're flipping this property. And I'm also going to pretend that we're going to flip this property all within the same calendar year. And for that reason, I'm going to log everything to my P&L, my cost of goods sold, my P&L. All right, so now your strategy on that's going to change depending on if it's a long-term rental, if it's a flip, if it's something that spans multiple years. Okay, we talk about all that in our course, but for now I'm just going to assume that everything goes to cost of goods sold. So I'm going to put in my, my purchase price. Okay, so there's my cost of goods sold purchase price. Let's say I purchased this property for $100,000. All right. And let's put a class on it. Let's say that I had closing fees, right? So buying costs of $5,500. Now, of course, our closing statements are a lot more complicated than this usually, but I'm just going to keep it really simple. $100,000 purchase, $5,500 in buying costs. Maybe there's like some taxes that I owe, and so I'd put that toward holding costs. Now, you could have a separate account for taxes. I'm just going to say holding costs. Let's say I owe $1,250 in taxes. And let's just say that that's it. If that's it, then, and if I'm buying with cash, then I'm going to pay with cash that exact $106,705. Okay. So let's just lock this transaction. Okay, so cash comes out of my account, and because I'm putting everything into my P&L, it's all going to go into my net income right here. There's everything I paid for it so far. Okay. Now let's say that I continue working with this property and I do some renovations, right? So let's add some expenses for those. Okay, again, 2018, just so it shows in the right place. I'm going to use products and services. If you are not using products and services, I really encourage you to do so. We have some amazing videos on that. It's one of my 3 fundamental tricks to setting up your QuickBooks Online to scale is to use products and services and cost codes. Again, we have a separate video on it. I'm not going to get into it right now. I'm just going to use it, and we're going to see this pop up on our P&L. Okay, so I spent some money on Rough Electric and it goes there. Let's do a couple more expenses. Let's say we did some demo. Now I'm spending from the wrong account here, but Okay, I'm just putting in some numbers to try to like show what a flip might look like. Okay, and then maybe we have more taxes that come out, right? So we're spending money on taxes. That's going to go up here to holding costs. Now your actual cost of goods sold is going to change from mine. Okay, we have different lessons on what your chart of accounts might look like. Well, let's say I'm paying taxes. Let's say I owe another $22.50 on taxes. And maybe you're going to put taxes in here. And actually, I'm just going to save this and I'm going to duplicate it. I'm going to copy that. And I'm going to say instead of taxes, it's utilities. And 125, whatever. Okay. Now let's just kind of call that a day, right? That's all I spent maybe. Okay. So I'm into this property, 125,000. Okay. So what happens now is we eventually sell the property. Okay. Now I've put in 125,000. We know that the amount that I put into it has really nothing to do as far as the buyer is concerned, the end buyer, as far as what they pay for it. We're going to pay it for market value. Okay. So your market value could be 200, could be 300, could be a million. It's going to be up to you. And that's kind of part of the whole deal. Let's say that we sell this thing for $250,000. Okay. So let's record the sale for $250,000 and let's see how our cash at closing compares to what's going on here. So what's going on here, we're into this property for $125,125. So I'm going to copy this report over to another tab and I'm going to start a sale journal entry. Now we're going to go through a few different iterations of this. So the first one, we're just going to do a journal entry. Let's say that I sold this thing in the end of November 2018. Okay. And again, because we're doing everything on the P&L, I don't have to balance any balance sheet accounts at all. I don't have any loans on this, not yet. Okay, so I'm just going to put my selling price here. Okay, so there's my selling price is my income. And let's say I sold it for $250,000. That goes right here. Now, if our property was on our balance sheet, we would not be putting the whole thing to revenue. We would be just taking the difference between the sales price and the basis. Again, we have various videos on that. The course has it all. We're not going to spend too much time on that here because I just want to show you the profit piece of this. All right, so we sold it for $250,000. Now, we know we always have selling costs, right? So we have to pay our realtor. We have to pay some other items too. So let's say we pay 6%, 0.06 times 250,000. So we have $15,000 in real estate commission. Okay. What else? We got some other selling costs too. We got like transfer tax, right? So let's put in 0.001 or 0.009 times 250. Okay, 2250 transfer tax. Okay, and then let's say one more thing happens. We have more holding costs. Okay, so, more taxes or utilities or something. Maybe it's water that is due, $450 in water. Okay, and then finally, at the very end, what happens? We get cash at closing, right? We have no loans on this property at all. Therefore, the difference between the selling price and my closing costs is going to be cash in my bank account. Okay, $232,300. I'm just going to make a copy of that, and I'm going to save and close. Okay, so $250,000, and then I have all my costs here, and there's my net income, $107,175. Now, the question is, why was my cash at closing not $107,175? The reason for that is I need to get paid back for all this other stuff that I did to it, right? I came out of my own pocket for this stuff. And so my cash at closing not only is my profit, but it also pays me back for all this other stuff that happened, right? It's all that. Okay, so if we go back into our cash at closing, we just think about what this is. Not only am I getting this because of this, sales price here, but I'm covering my other costs. If this was my profit, then we would completely ignore all this stuff. Okay. Now the common thing I have is like, well, what if I put this purchase on my balance sheet? Well, if you put your purchase on your balance sheet, let's go through that example too. So let's say what some folks will do is they'll put this as inventory. Okay. So purchase price, inventory, let's see, purchase. Other current assets, yes, sub account, flips in progress. Okay, so this might be a way to do it while I'm working on the property. Okay, so if this is the case, then my P&L looks a little bit like this. On my balance sheet, I'm going to have the property sitting there right here. Okay, so if that's the case, on our sale, what we would do is we would zero that out. Okay, let me find that sale. So if that is the case, I'm going to need a line here to zero out that inventory. So that's going to be my purchase price. Okay, flips in progress. I need to zero that out. And what I do then is my revenue goes down by that much. So this is what I was talking about here. Your selling price or your realized gains is actually going to be the difference between your basis, which is in my inventory, and my sales price. So the total here is going to equal to 250. So that is how I would take care of that. So if we were to do exactly what I'm showing here, what that'll do is same exact profit, okay, just different cash. Okay, so now my sales price is 150 because I had less cost of goods sold, but my net operating income is exactly the same. Still, my cash at closing is not equal to my profit. Okay, so that's with a cash deal. Now let's do a finance deal. Okay, so to do a finance deal, I'm going to do a few things. First is I'm going to put this back into cost of goods sold. Okay, and in this case, let's say that we got a loan for this. Let's say we got a hard money loan. Okay, we got a hard money loan of $106,750. Let's save and close. Okay, so if that's the case, now the project's going to operate the exact same way. I'm still going to spend the money. Okay. All right, now here, notice I didn't have any money for the rehab costs or any of that. So let's get into my sale here. And let's make some adjustments. The first adjustment is I'm going to get rid of this line. I don't need this anymore. We're going to go back to 250 on my sales price because I took it out of inventory. All right, now here I've got something to do in that I don't get it all cash at closing. I have that loan to pay off. Okay, I'm going to save this for a second and just check. What you have to do before you record the sale of a property where you have a loan is you must understand what that loan value is the day before you sell. Okay, so if I'm selling this property, I need to know that I have a loan balance of $106,750. My goal is to get this to zero by the time I'm done closing out this property. Okay, that's something I have to do. So on the sales transaction, I need a line here that takes in that hard money loan. And this would be on your closing statement, probably, unless you deal with your hard money loan outside. I need to debit that exactly $106,000. No matter how much I owe, I must debit that exact amount. Now, typically, I'm going to owe more than this, right? Because we owe interest. And so that's where we have our debt service. Now, you're probably going to be paying debt service throughout as well. So I'm just going to put debt service right here. And let's say that I owe like $110,000. That means I'm going to owe $3,250 in interest. Payoff loan, 122 Buffalo. Okay, now here, now I have cash at closing, $122,300. Let's save and close. And now same exact kind of thing here. Let me just make sure I got it all. $122,300 is my cash at closing. What's my profit? $103,000. Okay, they're not going to be equal. What's the difference between the 107 and the 103? It's the money that came out of pocket. Right? It's the money that came out of pocket is the difference there. Okay? So, or I'm sorry, what was the, let me just check the 122. Yep, the difference between the 122 and the 103 is the money that came out of pocket. So that's really like the answer here, right? When everybody's asking, why is my cash at closing not my profit? The answer is because you came out of pocket with something. The only way that would not be the case is if all of those expenses that you spend after you close on it are not financed or are financed. Okay, so your rehab costs, your $16,000, as well as your other holding costs. So in this case, I've got an expense for utilities, $125 and $22.50, as well as this $16,000. So what might happen is on our purchase, we might get like a construction loan, right? And so in addition to this private hard money, maybe I'm getting more than this. Okay, maybe I'm getting like 126 or 124. Okay, and then they're holding back $17,250. All right, so if that's the case, then what I have on my balance sheet, I've got a construction holdback here. So the way that works is we spend the money out of our own checking account. We're spending this money, then eventually we get a draw, right? We get a deposit that comes into our bank, okay? And where does it come from? It comes from construction escrow. We show the bank we spent this money, and they're going to give us, maybe it's $15,000. The thing is, it doesn't have to be exactly what it is. It doesn't have to be all that's in the account. Okay, so I got that draw, and now the day before I close, I have this draw to handle, this $22,250. So I've got to get that out of the way. And let me just go back here. Let's take that sale, and we got to do that all over again. So I'm going to delete this. Actually, let's leave it in there for now. I'm just going to say it's all cash at closing for a second. Okay, so we have to look at our balance sheet the day before we close, and we're not only looking at what the loan balance is, $124,000, but also the fact that I have $22.50 in construction escrow. I didn't use it. So in fact, they owe that back to me. So this amount, okay, need to go into this calculation. $124,000 minus $22.50. Okay, so let's go into this transaction and make one last edit to it. So now on this sale, I have to, let's get rid of my checking here. I have to pay off the loan. Let's start there. So I have my hard money loan. I have to pay that off. $124,000 needs to come off. Now I still owe interest on it, right? I still owe interest on it. Now you're going to have to, depending on what I think I have debt service, depending on your arrangements here. So let's say that I owe $4,500 in interest. And the construction escrow, they owe me, okay? They didn't pay it out yet. They owe that to me. So we're going to credit that. And then finally, cash at closing. Now here, you can see we're getting closer to the actual profit. So I'm getting $106,000 back. And let's look at what my profit is on this. $102,000, okay? So here, what we're seeing is the more we finance on a project, the more that we don't pay for ourselves, the closer the profit will be to our cash at closing, all right? Because other people are paying that on our behalf. The more we pay out of pocket, the bigger the difference in cash at closing versus our profit, because we're getting paid back for all those things that we've already put in. Okay, so key differentiator. So it's almost never the case. It's almost never the case that you are going to have your cash at closing equal your profit. Okay, very rarely do we have every single expense down to the penny 100% financed. And therefore, we need to start disconnecting the two. Your cash at closing is a cash flow metric. It's a balance sheet transaction. Your profit takes into account all the stuff, not just the closing that happened, all the spending that happened, no matter who spent the money. Okay, so it's really important we understand that. I don't want you to get hung up on it, because I understand why it's a complicated issue, but it's something that once we kind of see it in action, it's like, oh yeah, they almost would never equal each other. Okay, something to keep in mind. So let me know if you have questions in this, comments. Maybe there's a situation, a scenario that you thought they should have matched, but you're not sure why. Throw it in the comments. Email me, nick@incomediz.com. Also check out Real Estate Accounting Bootcamp. It is an amazing course. We just re-released it with a ton of bonus content, and it is available online, incomedigs.com/Reab, R-E-A-B. We have a link here, and I look forward to seeing you in that course or in all these videos that we're putting out on YouTube and on my website. Let me know what else you want to see. I'll continue to post really good tutorials and videos on how I do real estate accounting within my own business. I'll see you on the next video.